Hey everyone, and welcome to this week's On the Spot. I'm Zach Strickland here with, as usual, John Paul Hampstead. John Paul.
Hey.
How's it going?
It's going well, man. The freight markets are deceptively solid or surprisingly solid. Or I'm always waiting for. I'm paranoid about the bad news. Like, when's the other shoe going to drop? But right now, volumes are sort of horizontal, like you said before the show. Holding up pretty well, all things considered. Rates are, higher than they were for most of 2019. Kind of just slightly below kind of the June-July peak. And I think most surprisingly, tender rejections have kind of, solidified above 7%, which is where they again above most of 2019 levels. So it's not so bad right now.
No, it's not the worst. I mean, you expect this, softening this time of year in January. We really saw a quick decline out of Christmas.
Yeah.
And then all of a sudden, about a week or two ago, it just kind of hit the brakes. Tender rejections fell quickly off of their 14% peak, which again, the highest value of all of 2019. And then they kind of started leveling out around 8% and then have been slowly falling incrementally every day for the last couple of weeks, several days. And, I think we were talking about this earlier in the week. Now, the markets in the areas of the country that are having the easiest go of it, especially if you're a shipper, have been the bigger markets.
Yeah. It seems like freight markets are operating pretty efficiently right now.
Mm-hmm.
So, and what I mean by that is that the big volume markets are getting covered pretty well. So places like Los Angeles, Harrisburg, Pennsylvania, Atlanta, Georgia, Chicago are big markets in terms of share, have pretty low rejections.
Yeah.
Now we are seeing a couple trouble spots in places like Mobile, Wilmington, Buffalo, which, Buffalo's Buffalo. But Columbus, Ohio, interestingly, is tighter than the national average. And also, one of the major markets out west, Salt Lake City, is actually pretty tight. You want to talk about Salt Lake City?
Yeah, Salt Lake City was, not traditionally one of the favorite places for carriers to operate out of, but it's certainly been a growth market over the last several months, and a lot of that growth has come from the reefer sector. Surprisingly, out west, and not a lot of people think of Salt Lake City as this big reefer hub, but there's actually quite a few big, refrigerated storage facilities out there because you can distribute across the west out of there. But it's also a point where you could come out of the Pacific Northwest.
Wasn't C.R. England always a big refrigerated carrier as well? Concentrated in there.
They are in the Salt Lake area. They originated
Plain
there.
City,
yeah. But at the same time, like you have all this produce coming out of the Pacific Northwest, potatoes, onions. I was talking to Kent Baker earlier today about the Pacific Northwest, how they're constantly on this. They're a lot more volatile of late. Last winter was...
Especially the minor kind of eastern markets in the Pacific Northwest.
Yeah, we're not talking Seattle or Portland.
Tight.
We're talking like Pendleton, Spokane, Twin Falls, Idaho, Boise, all those cities out there because you have a lot of potatoes there. So, a lot of potatoes, a lot of onions, and again, we had a bad potato harvest this year. Apparently, due to that early cold, it was warm out east, freezing out west. Really did some damage to the potato crop.
Interesting. I always want, I've seen those images of those massive caves that they have out there, just like full of millions and millions of potatoes, and I wonder, like, the stock to sales rate or the inventory to sales ratio. How does that work? Like, how long can you store potato underground for?
Well, Ken Baker says that they need to be they keep them around 42 degrees. That prevents them from, sprouting and doing the root thing and going soft on you.
Interesting.
So, because technically, you don't have to store potatoes in the fridge or anything like that. So people don't think that it's a refrigerated item.
They need to be in the dark.
Yes.
So they'll sprout if they're
in the light.
Why are we talking?
Yeah.
It's funny. But yeah, so there are a couple of markets where things have tightened up. I think that's, it's partially weather. It's partially just, kind of what happens, just seasonally, like when you have unexpected volume surges. But can we talk about West Coast ports a little bit? There's been some interesting action over there.
Yeah, so the West Coast, we're coming up on Chinese New Year.
Right, which is January 25th.
25th. So that means that we can expect an increasing amount of freight coming into that market, loading it up. right before the the holiday out there. Now, again, it doesn't mean that January 25th the freight is just going to stop or die. It means that about 4 to 6 weeks after that period of time, you'll see this big troughing effect. But right before that trough, you're going to see this big spike. I believe last year we saw a 20% decline in LA volumes.
So we expect that to occur in sort of like mid to late February?
Be like late February, early March.
Okay.
Last year we saw a 20% decline in LA outbound volumes off of this peak.
Right.
And we saw
for trucking especially.
For trucking.
Yeah, okay, I see.
For rail volumes, it was a 24% decline, and you can see this happen every year. About 4 weeks after Chinese New Year hits, because that's traditionally when it takes them that long for that freight to stop rolling off out of the area over there, and then again it takes 2 to 4 weeks for that boat to get over here.
Yep.
And then it takes them a while to get that production back online once they start back in the factory.
Yeah, it's traditionally a time when Chinese manufacturing workers take the opportunity to change jobs. Yep. They often don't tell their employers that they're not returning after the holiday. They just they come back to the city, find a new job. Last year, obviously, there was just a massive step down in Chinese manufacturing and exports because of how bad the trade war was getting and how bad economic growth in China was. But we don't expect that this time. We think that the recovery should be fairly robust. It looks like the Chinese central bank. Phase one of the trade deal should be a positive. The Chinese central bank is easing a lot. They've sort of reduced the amount of cash that the banks have to hold in reserve. Mm-hmm. To basically let them lend more, which it's always a great sign.
It's a little risky.
Yeah, but what that does is allows more jobs to be created, more goods to be manufactured. So as long as the American consumer holds up, and we just got the retail sales numbers for December this morning, crazy year-over-year growth in December.
Really good. And again, they
was it 5.8%?
Now, there's two things happening here. Last year, you probably Last year, you probably don't recall, but December came in unusually soft. Like we weren't expecting it to be that off. We actually had a lot of people question the government data on that. So 2018.
Yeah.
2018's retail sales number was actually really, really low. You can see it in this chart. I was looking in Sonar. There's literally like a little notch right there that bumps down out of nowhere. And but some people question, because there were a lot of positive results from Visa, for instance, was like, we had a great year. So that's a contributing factor, but I also think that we do know that this year's retail sales situation was strong. We could see it in our data. We could see it in our trucking data. We can see it in the maritime data coming into the country. Think about it. We had a compressed retail season in terms of losing a week between Thanksgiving and Christmas.
Right.
Truckload volumes were 4 to 5% higher for 4 weeks because you have this compression. Again, that just meant that the demand side was strong, and I think that's a positive thing. And the consumer, again, we've talked about it me and Anthony have talked about this consistently on Freightonomics and our monthly webinars, how retail has been kind of the beacon of hope or light for the economy.
Right, which is fine for the U.S. because it is a major part of the economy. So it's not like it's the one small thing that's pulling the economy along. It's the major big part of the economy. The consumption sector is doing well.
Yeah.
And hopefully this phase one trade deal, even if it's sort of incomplete, even if it's limited in scope, it might be enough to start changing kind of business community sentiment around investment. I mean, I think I've read from numerous analysts that pretty much everyone expects strong CapEx growth in 2020 simply because the companies didn't spend the money
in 2019.
Last year. So they at some point you have to reinvest just for replacement and things like that. There could be some pent up demand there, which I think will be a positive for flatbed and in industrial production in general.
Yeah, I mean, I think there's a lot of positive. At least there's optimism.
Yeah.
We haven't seen this show up yet. I know there's a lot of sentiment about the market being this. I know I've read articles from Ravi talking about how we really expect a robust second half of the year at least.
Right,
but
right.
More trucking market closer to 2018 versus 2019. I think that might be a little bit of hyperbole there. Because we just haven't seen it show up yet, but that doesn't necessarily mean it's not possible.
Let me ask you this, Zach. How does your thesis change if we are able to finish January with above a 7% OTRI?
I think that's
like,
a
what is
huge
that?
signal.
What does that tell you?
That's a huge signal. If we finish the month, now again, discounting the fact that we're going to see a little bit of an end of the month bump like we do every month, tender rejections, because you do have these surging volumes.
Yeah, so let me amend that question. What does it tell you if we stay above 7% the whole month?
If we stay above 7% throughout the rest of the month, we are looking at probably a significant change in the market dynamic.
That tells you about that the capacity story is finally starting to kind of take hold. It tells you that demand is holding up, and pricing power is shifting.
Right. It means that the supply side is actually in a correction.
All right. Now, what are the odds of that happening?
They're very low. They're very low.
Oh, you say very low. Okay.
Yeah, I think we're still in this. We're in a flat market right now, a sideways market, which is, it's a positive sign for January. But it doesn't necessarily mean we're signaling. I mean, year over year, we're still flat in terms of volume.
Right.
Year over year, we're still on par with tender rejection rates in general. Again, discounting the fact that we were still coming out of this hot 2018 market.
Right.
If we do, I think we will surpass that. I think we will start to see this year over year change in tender rejection rate, because we'll get a lot better comps. These 3-4% tender rejection rates we saw in April and May last year, I think we will definitely see growth year over year in that number. I don't think you can expect that to have held up. Again, trade war has now been somewhat alleviated.
Right.
A lot of the volumes,
at least directionally, it's changed, which is what matters for markets that are forward-looking.
For sure.
In a lot of ways, it's what matters for CEOs, and it's what matters for procurement strategies and planning and stuff like that.
Yeah, you can't, especially on the spot market. The spot market side is what leads the contracted freight side. So I think this year, some of these shippers probably were able to negotiate down off of 2018. Again, if they were getting 5 and 6% rate increases year over year in the previous year, they probably had to pull some of that back at times. I think this year they're definitely looking at minimum a 1 to 2% increase year over year.
Yeah, I think
when it's all said and done.
As far as I know, I think that there's a pretty unanimous consensus that 2020 should be better than 2019.
Yes.
For trucking, for transportation companies and transportation providers.
Yeah, I think that's. It seems like it's very likely at this point. I mean, we saw that directionally in the spot market from, June to Christmas. We see those two peaks, and the Christmas peak was higher than the June peak or the July peak, and that tends to, I think, the last 5 years, it predicts the direction for the market for the next year.
Okay.
So
great. Oh, that's interesting.
Yeah. So, but it's not a huge jump, mind you. We're not going to see again Ravi's statement about it being a 2018 year where we saw 15 to 20% is. I don't think that's likely. But again,
it's unlikely just because
statistically speaking,
that year was
a combination of multiple things that have to happen. If we have 3 hurricanes, major hurricanes hit the country this
starting to see a smile on your face.
Yeah, that's now we're starting to talk more likely. But yeah, so the market's flat for today, but we are looking into the future a little bit. We do see some signs of a heated market here coming up in the next few weeks to a few months.
All right,
JP. Well, until this time next week, thanks for watching and tuning in. Be sure to check us out on all our social media and all of our videos moving forward. Have a great week.